And the tokenization has been something that a lot of us have tried to do. It just hasn't worked in the way that we had hoped. It just hasn't connected with the psyche of the investor in such a way that they want to do it. But I think that there's a huge potential there. And for anybody that's listening that is trying to fund their projects, there may be some opportunities to to do a tokenized American housing fund or whatever you want to call it to put projects together.
Hey, what's going on, everybody? Welcome back to the Land Development Podcast. I'm your host, Ryan Glick. We have an industry news episode for you today, and joining me, as always, is Charles Covey. What's going on, Charles?
Hello.
Well, we talked last time on our industry news episode. I don't remember the episode number, but it was upper 90s. But today is episode number 99, which means that the episode coming tomorrow, which all of you need to tune into again, is episode number 100. So,
wow.
Yes, exactly. Round of applause for us, please. It's been a it is. And it's been a long time coming. And again, I know I say it a lot, but again, we really appreciate all the support from all of you who tune in every week and comments you leave for us on social media and everything. It means a lot to us. So again, really appreciate that. But with that said, we will go ahead and get into our first article for today's episode, which comes to us from Globe Street. Headline reads, Goldman Sachs warns weak housing sector could tip U.S. toward recession. Summary from this article, Goldman Sachs chief economist Jan Hatzius projects an 8% year-over-year decline in residential investment for the second half of 2025, citing affordability challenges and declining immigration. The use of mortgage buydowns to lower rates indicates affordability remains a central issue for buyers. Slowing immigration, particularly due to intensified border control measures, is expected to limit new household formations, dampening housing demand. Weakening labor market conditions, as suggested by recent job data, could further pressure housing trends. Hatzius forecasts subdued multifamily home building through December and a contraction in new single-family starts. Economists like Mark Zandi of Moody's warns that unless mortgage rates fall significantly from near 7%, the housing sector could become a full-blown headwind for economic growth. Historical analysis identify housing as a leading indicator of recession, with declines in residential investment often preceding broader downturns. So, Charles, it really seems like we're at a really interesting time right now. Like something has to happen. Not sure what do you think needs to happen, or what do you think about the analysis here?
Yeah, this is a really wild scenario that it looks like, based on what they're saying, the recession is this impending thing. The interesting part is, could we turn it around? Could you save the country from the jaws of a recession? And I don't know. I'm not 100% sure that that's possible. But I think that to the point of this economist, housing is such a big chunk of the GDP. I think around 18 or 20% of the GDP. So it does have a big impact on that engine, and it's a factor. I think you and I have talked about before. We're concerned about the inflation portion of that if you try to spin housing back up with some low interest rates. The household formation is an interesting one. And also, let's not forget, the U.S. population as a whole is not growing as fast as it once was. So we built this on such a consumer economy, and we're not consuming as much. And based on birth rates and immigration won't be consuming as much in the future. So we've probably reached peak U.S. consumption already, and maybe trending down. So we've got to find other ways to create value and other ways to bring dollars to the U.S. other than just us consuming and passing money back and forth. So very interesting times. I think that the recession is looming. It's going to be maybe possible that they can save us from it. But what are your thoughts, Ryan? Do you think it's possible?
Yeah, I don't know. I agree with you. I think that Trump's calling for, and we talked about this on the last episode, but Trump calling for, we need interest rates down to 4%, and us knowing that he generally will go really big with the things that he's saying. And then, maybe it ends up being a portion of that. Maybe it's a half point cut or something like that, like we talked about last time in the fall, or I guess next month that's pretty soon here. But
Yeah.
I think one of the things I think about too with what you're talking about there with the lack of growth, we do have a lot of multi generational households that seem to be growing in this country as well. And a lot of that has to do with the cost and the inability for people to afford. I can't remember the exact age, but we had looked at some data maybe a month ago or so that showed that the age of individuals buying their first home had increased by quite a bit. So they're,
Yeah.
yeah. And so maybe with rates coming down, that will trigger some of those people to go out and purchase their first homes, go out and actually get some things happening. I don't know.
I don't think that typically is the way it goes, though. If you've got let's say someone gets out of college, they're like, whoa, my general studies degree is not going to make me enough money to do much of anything. So I'm going to have to go back to the house with mom and dad. They're not going to go straight from that to buying a new home. In most cases, they're going to do the mid range, which is going to be go to an apartment, then go to a better apartment, then maybe a built to rent home, and then maybe buy a home at some point. So the household formation element impacts other areas before it impacts new homes. Usually, that's not always the case. You see, especially with, let's say, the households where you've got multi generations and entire families all cohabitating. Sometimes those will break off and go straight to a house. But a lot of that in between is going to be apartments. So that's an interesting one. The household formation element is pretty important. And I think that that's a direct result of housing cost in relation to income. And we've seen that change over time. Housing cost in relation to income is a bit skewed.
Yeah, that's a good point. That makes sense. Like how you describe that does make sense that they would jump to an apartment first before going to a home. But I guess the big question then ends up being if how much of a decrease in the interest rates would create action.
Yeah. The general rule is 5% is where everybody's comfortable and everything moves. I think probably somewhere between 5 and 6 is actually what it takes to get big movement. But that's what most of the home builders talk about is in that 5 to 6 range, closer to 5. And people just kind of mentally can wrap their mind around that and move forward.
Yeah, and we're not likely going to see that here in September.
We're a ways from
Yeah.
that. Ways from that. Now let's go back. We talked about this before. We go back to my dad talks about buying his first house. I think he paid like a 16 or something, somewhere in the mid to high teens interest rate, which just seems bonkers.
Crazy.
Like holy crap, how did you pull that off? But housing as a percentage of income was a number that still made it make sense, and he still wanted to put his family in a home, and it all worked at that time. I don't think you would see that work today. I just don't even see it as possible. But it was a big chunk for them, and it was challenging.
Yeah, I wonder. I don't have
But
the date.
but
Oh, go ahead.
that just shows that interest rate isn't everything.
Yeah, I was going to look really quick at the Fed meeting schedule. So it looks like September 16 and 17. So we have about. I mean, it's going to be about a month before their next meeting, and we see what type of action they end up taking. Um, and yeah, we'll keep an eye on that. I mean, it won't happen in our next episode, but in a couple episodes, we'll be able to talk about the reaction to whatever move the Fed makes or doesn't make on that date. Well, let's go ahead and move on to our next segment, which is from the comments. I've got a few of them here. I like to pull up different comments from the different social platforms. Today, it's going to be all from TikTok because you get a good variety of people from the right and from the left arguing about what they think is happening. And it doesn't necessarily mean that any of them are right, but it tells you what some of the talking points are that people are talking about on the different sides of the aisle. And so I like to bring those up here sometimes when we get some good arguments happening in the comments. And so first one is not necessarily an argument, but this one was too good to pass up and not show. So this one comes to us on TikTok from Luke NYE1. His comment is, no offense to you guys, but clipping something from the Land Development Podcast about calculating parking spaces to put on TikTok is crazy. This thing is getting skipped in milliseconds by anyone who it lands on. Just sounds like the most boring thing imaginable. Well, there's a response to this one is from somebody else who says, unless you're interested and watched the whole thing. I think this is funny because we've actually had people reach out to us and say they found us on TikTok. So you know what?
You know it's working.
Yes, yes. And he took the time to comment. So, hey, we got him. We got him. All right, next one here. This one comes from What So PWS 7EA. His comment is Democrats are doing multi dwelling houses wherever they can to expand the voting population in urban settings. And it's obvious that is why their platform is all about affordable housing, because affordable housing is crap condo apartment housing, and it doesn't mean home ownership. That's not what the Democrats' platform is about. They want cheap rent.
Yeah, there's a little bit of a misunderstanding, I think, from this person because they're talking about condos, which are owned. So I think maybe their understanding of the general nature of how the system works is maybe not 100% there. So interesting perspective. Can't say that I agree with them.
Our next one here comes from Miss K Moon. There's a reason the Fed must operate independently. Are you advocating for a president controlled Fed? If Trump had his way, he'd create a depression. Interest rates were coming down before Trump took office. The chaos he creates does not help our economy.
Yeah, well, I have my own thoughts on the Fed. I would love to see, I would love to see us take back the control of our currency. I don't see that happening, though. I just think that there's too many, too many things at play there for us to make that happen. I mean, there's wars have been fought over less than that, so I don't think that would ever happen. But maybe one can hope.
Yeah. All right. Last one here. This one comes from the Real Omega. Powell has already said under oath before the Senate Finance Committee that he expects the Fed to cut rates later in the year, so long as the tariffs don't send inflation soaring. If they lower rates, it'll have nothing to do with Trump. LOL.
Yeah, I mean, there's a lot of things that are happening. One could say that if Trump had done nothing and not mentioned the rates and not applied all the pressure, that they might come down anyway. Possible. One could make that case. I don't know if it's true. Really interested to see how the tariff stuff plays out into inflation, and that's probably something we need to follow up on in our next episode. Is to really dig into what do the early numbers say, because it takes a while for this to shake out,
Right.
and we may not even have good reporting yet. So it would be very interesting to see what are the impacts of tariffs. The unfortunate thing is if there's an impact to a business, it's just getting passed on to a consumer. And that's just the nature of how that goes. So businesses aren't going to shrink their margins because of a tariff issue. They'll just raise prices. So we'll see how that plays out. I think that's something we probably need to follow, maybe as important as interest rates over the next 6 months.
Yep. All right. Well, let's go ahead and move on to the next article here, which comes to us from Business Insider. Headline reads America's Next Big Land Grab. Summary from this article: U.S. home builders are adopting land banking, acquiring rights to future development sites without immediate ownership to manage cash flow and prepare for future demand. Despite current high mortgage rates and a sluggish market, builders are securing land now to capitalize on anticipated future demand. Land bankers purchase shovel-ready lots and sell builders the right to develop them later, allowing builders to control land with less upfront investment. Publicly traded builders now option 74% of their land, up from 36% in 2017. In Q2 2025, Lennar acquired nearly 22,000 lots from land bankers for $2.7 billion, indicating a significant investment in future development. Land banking is seen as a strategy to mitigate the cyclical nature of the housing market, enabling builders to quickly ramp up production when demand rebounds. If successful, the strategy could alleviate housing shortages and potentially bring down prices for buyers in the future. Thoughts on this, Charles?
Yeah, that last statement, if successful, the strategy could alleviate housing shortages. Yeah, I don't think that last statement is true. Really, the point here is if you're a public builder, you can't have land on the books. And that just from an accounting standpoint does not work. And so you've got to find a way to exert control on a site and get the sites that you need and have this pipeline of lots because you can't just say, oh, you know what, next month we need to increase starts. Let's go buy some more lots. You don't go to Walmart and buy these.
Right.
So you have this planned out over time in places that you want to be building in and places that you understand and places that work for the demographic that you're selling to. So this is a multi-year game. You've got to have a 4 or 5 year pipeline out ahead of you. And in order to do that, you can't have them on your books as a public builder. So you've got to have a land banking scenario. And there's plenty of different ways that groups have solved this, or using independents, or they, D.R. Horton bought Four-Star, so that kind of acts as their internal land banking and development arm. And there's plenty of ways to solve this. Everybody does it a little bit different. But if you're a public builder, you've got to do this. If you're a small regional builder, it's harder. If you're a local builder that's just doing a few dozen, or maybe even a few hundred homes a year, it's more challenging to make this make sense, because it does cost more to land bank. So, for example, the company that's land banking, we could do that. We've been approached to do that several times, where we go and get a piece of land under contract, then close on it, get it entitled. In some cases, might even develop the lots depending on the scenario, and then there's a predetermined price based on the returns that we need. It's basically like, hey, we need to make this money. You're willing to let us make this money and pay us the amount we need at this point in the future in order to deliver the thing that you want. And it is a system that works. It's there's a lot of developers that have these relationships, and it makes sense, because if you structure the contracts correctly, it's a pretty set, guaranteed scenario. Although there's almost always some kind of an out. And I think something that you and I talked about recently is that there apparently are some builders that are finding ways to use that out right now, and back away from some lot deals and land deals that they have banked, only because they're just concerned about volume and what that's going to look like in the future. But land banking is here to stay, and land banking is continuing to become a major, if not the major, methodology for the largest builders to acquire land and lots.
Do you think too many people are? I've heard just locally here where I'm at in Des Moines. I know there's developers who are staying bullish and they're still looking for land to purchase for their next deals, because they make the comment that, hey, just like what you said, if we sit on the sideline when things do bounce back in whatever time period that is, I need to have everything entitled and ready to go, so that way we can keep moving and stuff. Otherwise, if you get to the point where everything's all good, then you have to go try to find the land, you have to get it entitled. Now you're way behind at that point. Do you think there's some of these companies are making mistakes, like going and sitting on the sideline or getting out of deals and everything, or you think they maybe have other options somewhere and they're not being short-sighted?
Well, I think there's different answers to that. So it depends. If you've got a near-term deal, let's say you've got to go close on some lots today, but the next 6 months you cannot sell those, or you're not confident that you can sell those, then that deal you might have to walk away from. You might not have a choice. But if you're looking at getting deals in the pipeline for the next 3 and 4 and 5 years, you would be very short-sighted to not be thinking about that and what those numbers might be. You might not be doing the same volume that you did 2 years ago, in a post-COVID world, and certainly not in a pre-2008 world. But at the same time, you've got to be planning ahead. These are large businesses. They're not just going to shut down. So you've got to be looking ahead and planning for what that might be like. And anybody that's forward thinking they're going to be looking several years down the road. And there's always going to be a pipeline built of this many lots this year, this many lots next year, this many lots the year after that, and so on. So those numbers may be adjusting, but there's always going to be stuff in the pipeline. Has to be. I think the smart people in the business are not overly reactionary. They're looking at long term. They have to make some adjustments for the now, and we see this in other industries. We'll use an example. So the major oil producers, it doesn't really matter what oil is. They're still acquiring leases. They're still developing. They're still drilling wells. They're still fracking. They're still doing all these things, even if oil goes to 30 or something, because they have such a long-term plan. They're sitting on plenty of cash. There's no reason for them to slow down. Now, the smaller regional guys just don't have the dollars to do that. They tend to be more reactionary, where they're going to have to shut down based on current prices. Whereas the big guys, they're still moving regardless. And I think that is reflective in the home building business as well. Kind of a similar scenario.
All right, well, let's go ahead and move on to our final article of the episode. This one comes to us from The Guardian. Headline reads, Trump signs order to allow crypto and real estate investments in retirement plans. So before we get into the summary from that article, I actually pulled a quick AP video that has a little bit of Trump talking about this. So I'm going to go ahead and play that really quick here for us. It's about a minute. It looks like a minute and 40. and then after that, we'll go through the summary of it and we'll react.
This is not an auto pen, by the way. And with today's signing, we're pushing even further into the exciting new frontier. Just as I promised last year, the Genius Act creates a clear and simple regulatory framework to establish and unleash the immense promise of dollar-backed stable coins. This could be perhaps the greatest revolution in financial technology since the birth of the internet itself. Let me say the entire crypto community, for years, you were mocked and dismissed and counted out. You were counted out as little as a year and a half ago. But this signing is a massive validation. And even before this signing, over the last year and a half, I think your stuff has gone up more than any stock, or just about more. A couple of stocks that were pretty good, I will say. But you have certainly, as an industry, gone up more than anybody. Nobody's gained the respect in such a short period of time. But this signing is a massive validation of your hard work and your pioneering spirit and your ability to never give up. You've made our dollar look really good and strong and powerful. It's good for the dollar and it's good for the country. And that's why I backed you at an early stage. And I also did it for the votes, because you did come out and vote, I will tell you. Yeah, we worked hard. It's a very important act, the Genius Act. They named it after me, and I want to thank you. I want to thank you. This is a hell of an act.
Of course, he says he named it after me.
Got a little humor in there.
Yeah. Well, I'll give a quick summary here of what exactly went down, and then I'd be interested in getting your thoughts on this. So Donald Trump signed an executive order permitting, I don't think this was an executive order, was it? He talked about it being an act. So it must have been was it a bill? From what I see here, it looks like it's the Genius Act it's a bill. It's not actually an executive order. So I'm not sure why.
Then it's actually something, because executive orders in a lot of cases don't.
Yeah.
Don't do anything. So if it's a bill that's in motion, what's the summary say?
So basically, it's permitting cryptocurrency, private equity, and real estate investments in 401k retirement accounts. The order aims to open the $12 trillion defined contribution market to alternative asset managers, aligning with Trump's pro-crypto stance. Following his recent launch of a cryptocurrency enterprise, Department of Labor is directed to collaborate with financial regulators like the SEC and Treasury Department to consider matching regulatory changes. Supporters argue the move offers diversification and potentially higher returns, especially for younger investors. Critics warn of heightened risks due to crypto's volatility, high fees, and low liquidity compared to traditional assets. Analysts and legal experts anticipate challenges, including litigation from investors unfamiliar with complex investment products. Major firms like BlackRock plan to introduce crypto-inclusive retirement funds, though industry leaders acknowledge significant legal and regulatory hurdles. Trump also issued a separate order addressing the alleged debanking of conservatives. Opponents like Senator Elizabeth Warren have expressed concern over the lack of transparency and investor protections in private investments used in retirement savings.
So I'm curious to see how this plays out. I haven't read the actual bill text. People can already invest in real estate with their retirement accounts through a self-directed program. So we participate in those, and they're very familiar with those. So I don't know what this is changing specifically. So we'll dig into that a little bit. I think adding crypto to it is interesting, although the volatility and the risk is still there. And this coming from somebody who owns crypto. I'm a fan, but you have to know that it could all go to zero. There's too many things there that we don't control. I don't think it's going to zero anytime soon, but always could be. Just like any stock, you get something happen and it goes to zero. So I think maybe that's an interesting idea for a retirement account. I don't know that most people in retirement planning should have high volatility or high risk in their retirement accounts, but we will see if we have stability coming to that market, which that would be the idea, is that you want to create stability before crypto can be a wealth building asset. You have to create stability, and so using gold to back something or using some other methodology to create stability. They've tried to do this with some other cryptos and USDT, and it hasn't worked well. but there are ways to do it. So creating some stability might give that, actually a retirement account worthy scenario. But I think at this point, it's probably actually not.
Yeah, I think crypto is an interesting thing too, just in general, because a lot of people, the reason they like crypto or they get into crypto is obviously it's not the dollar, right? But it's still a fiat currency. It's not backed by anything that's like real tangible, but
Right.
it people like it because it could go up really fast. You've seen a lot of crypto millionaires out there who have been made over the years from crypto. And if you stabilize, crypto coins or any specific crypto that you want to use for purchasing, it won't be as exciting to people to hold it because it's going to be just like cash at that point where
Certainly.
maybe it doesn't devalue as much, but it's still not going to make somebody
Right.
wealthy like they like with crypto today.
Right. Yeah. It will not have the same kind of buzzworthy nature. But that's
Right.
the idea. You want the asset to mature, and you want it to have stability. But you won't see the crypto bros who made
Right.
$1 million buying it at bought it at 10,000 and now it's at 100,000, or they bought it at 2,000 and that's 100,000. So good for those guys. I bought some crypto early, so I've done okay. But mine's just sitting. I'm not cashing anything out. So
Yeah.
it's more a long term play for me. But some people have done well for it. For crypto, it's made some millionaires for certain. I think there's definitely more millionaires to be made in crypto, no doubt. Uh, but I don't know that it needs to go in retirement plans just yet.
Yeah. What about the real estate side of this? You had mentioned that real estate, you already can invest in real estate through different
Yeah,
holdings.
yeah, and a lot of those um, can do REITs and other items, or and other type funds like that. I don't know the language of the bill, so we need to dig into that a little bit more. The challenge with this, let's say that it opens up this, they're theorizing this could open up this tsunami of dollars that needs to get invested into real estate through these retirement plans. Um, Challenging though, because the the most common institutional level real estate play over the last number of years has been multifamily. Those right now are not good. They don't make money. They don't pencil. There's a fraction of them happening. 50 or 60% decrease in multifamily deals, and most of the ones that are happening have to have some type of tax credit or some type of opportunity zone or something to make it make sense. So that asset class is really not even investable hardly at the moment. Industrial still decent. There's a few other ones that are okay, but not the returns that we were seeing. So I'm really curious what that does if you get a whole bunch of money that can now get into that marketplace. It will be really interesting, and I'm just personally in that marketplace, and as we put capital together and build out a capital stack for our projects, really interested to see how that'll play out. So this is going to be one that we'll be watching in house very closely, and I'll dig into this a little bit more.
Yeah, and at a high level here, just really quick, I was pulling this up while you were talking through that, but it looks like what it specifically does is that it allows investors to invest at more fractional levels because the these different commercial real estate can issue tokenized. They can like basically issue tokenized coins to allow people to then fractionally invest in projects, and so people can invest at a lot lower amounts and things like that. And I know people are doing that today, but I think the idea with this is that it's allowing people to now use their 401k dollars to do this versus just money out of their pocket
So
normally.
the challenge there will be some crap,
Right.
right? There will be some scams. There will be some crap. You've got multifamily doesn't really work. You've got the office market is in the tank. So then where those dollars go? Um, and the tokenization has been something that a lot of us have tried to do in the past, and it just hasn't worked in the way that we had hoped. It just hasn't connected with the psyche of the investor in such a way that they want to do it. But I think that there's a huge, huge potential there. And for anybody that's listening that is trying to fund their projects, there may be some opportunities to do a tokenized American Housing Fund or whatever you want to call it to put projects together. So the opportunity I think is excellent. We'll see how it plays out.
Yep. All right. Well, that brings us to an end here. Charles, I never asked you on the show, but you're clearly not at home right now. Where are you at today?
I'm in Mexico at the moment.
All right. Well, You guys heard it there. He's somewhere different, as he always is. All right. Anything you want to add, Charles, before we wrap up?
No, it's a good one. Lots to follow.
Awesome. All right, guys. Well, this is, as I said at the start, this is 99. So tune in tomorrow for episode number 100, and we'll see all of you then.